So good morning and welcome to Bonhoeffer Capital's quarterly conference call. Today, Keith will be providing an update on the Bonhoeffer portfolio with a focus on two important themes: recurring revenue streams and masterful capital allocation, as he discusses Asbury Automotive and introduces North American construction. As always, this presentation is for informational purposes only and is not intended to constitute a sale, solicitation, or advice. We invite qualified investors to get in touch with us separately and discuss the partnership. And during the presentation, which Keith is about to get started, we invite anybody who wishes to submit a question to go ahead and submit it through the chat, and we can make sure that Keith addresses it in real time. So with that, Keith, I'll hand it over to you.
Oh, good morning, everyone. It's a nice morning here in Rochester, New York. We're getting fall here and it's getting cooler, but what we'll do here now is we'll sort of go through what our quarterly sort of performance here and our strategy here. So this is the Q3 partner presentation. Got the disclaimer. None of this is investment information. It's for information and entertainment purposes only. Just an overview of the Bonhoeffer Fund. I mean, just to give you a framework of where we're coming from, started in 2017. Initial strategy was value in special situations and emerging and developed markets. Now we're evolving to include frameworks with growth drivers and slower growing markets, looking at the durability and the growth aspects of businesses. Over time, this has increased. In our last quarterly, it represented about 50% of the portfolio. Now it's 60%. I'm expecting that to increase over time as a number of our holdings have become special situations over time. And as those special situations play out, we'll liquidate those and put them more into sort of this growth value type strategy that we sort of evolved into and really like at this point. And so basically what we're doing is we're focusing on firms that generate excess cash flow to allocate to management, and that are expert capital allocators. That's the focus at this point. And this is a chart we show every quarter. This gives you a rough idea of what's in your portfolio, what type of specific, theme that we've basically been investing in, and how the portfolio holdings correspond to those themes. The first one is sort of the compound mispricing. We've talked about that in the past. That theme has actually become less important over time as we focused more on these capital allocation champions that have durable moats. Mischaracterized firms is primarily associated with most of our firms, because the reason why the mispricing is there is because a lot of that is happening. So, for example, you get a company that's let's say a distributor or dealer of a particular product, and the pricing of that particular dealer or product will be based upon the underlying sort of overall industry dynamics. But as you'll see in our presentation, we talk a little bit more about dealers. There's a lot more recurring revenue in dealer type of situations or distributor situations than there are in OEM production. And so that's an example of sort of a mischaracterized firm. Public LBOs are firms that use debt to primarily increase the returns. Consolidation is situations where you've got a very fragmented industry. And this is another theme that we've sort of been increasing over time, in the fact that it just, as the firms can get bigger, as they get better, consolidation can add a lot of value, especially if it's consolidation within an industry where companies know other companies in the industry and pay reasonable prices for those. And that's sort of been what our focus has been in that theme. And finally, capital allocation champions. These are guys that in industries that have moats, that really understand how to use capital allocation, and that has been increasing. So as you see over time, the consolidation capital allocation is 50 to 60%. Last time, I think it was about 10% lower in terms of our allocation in the portfolio. So that's increasing over time, and I expect that going forward. Our overall sort of valuation metrics is to the right. And you can see we are getting these increased quality type businesses, but the PE still, in terms of a valuation metric, and the growth is still relatively modest. So we've got our weighted average PE in our portfolio is roughly 6. The growth rate is 11%, which has gone up from roughly 10% last time. EV to EBITDA is 4.2, and most of these on average are modestly. The other differences to the indexes that we benchmark ourselves up to is we're about half the size of the small cap, international small cap value, and significantly lower than the overall MSCI XUS um, sort of benchmark there. So that gives you an idea of where the portfolio is going. Now I'm going to talk specifically about some of the themes and some of the behind the scenes rationale for what's going on, and give you some examples, as Jessica stated, in terms of some companies that sort of meet these criteria. So as we spoke about last time, basically we're still following a value approach. We have a different starting point, focusing primarily, I think, on the company's durability and growth prospects, and then finding companies where those two boxes are checked, and then looking at valuation as a maybe a differentiator at the bottom, but in essence trying to set certain hurdles of growth and durability. So durability is really important to ensure that you get the rate of return you expect. What's also happened over time is with the rise in interest rates, the expected return of investments has also increased. Now, right now, you can go out there and get secured first lien debt on small growing companies, probably for 12 to 13% expected return. If that's the case, then for equities, the benchmark we're looking at is probably high teens, low 20%, if not higher numbers, and still getting modest multiples. And that reduces our universe by quite a bit. And so one of the key aspects of that is first to identify the firm's moat, which is the thing that protects their profit. And then the other key aspect is that moat widening or narrowing. If you can find a company whose moat is widening, what that really does over time is the company's getting better from a moat perspective, in terms of them getting further away from other competitors, and it really insulates the return on invested capital and makes that number bigger as it growing over time. Is management enhancing the moat via operational improvements in capital allocation? This is sort of that capital allocation champion sort of theme we've talked about either previously. Typically what happens in these businesses, if you can find guys that can have operational improvements, come up with decent metrics that can do that, and have good capital allocation, that enhances the business. And so in essence, what you've got here is, in the way I like to think of businesses or stories of companies, is sort of like a movie. We're seeing what's happening in the past, we know what's happening now, and we're trying to project into the future as investors. And so what we're trying to focus on are movies that basically are movies where the moat has widened over time, where we've seen evidence of that, and where we've seen, okay, and we expect this to go into the future. We expect there's a market that they can grow into in the future from a total addressable market perspective. So these are three examples in the portfolio of those types of businesses, and these happen to be the highest weights in the portfolio at this point. A company called Ashteed, which is in the equipment rental business. Return on invested capital in North America is like 19%. You see the growth there is 15 to 20%. The PE is 14. It bounces around, so it may be closer to 10 now, because a number of these companies, the names have moved around a little bit. Builders First Source, the PE of that one, again, that one's probably below what this one's here, because again, recently it's gone down a little bit, so it's probably like 9 times. But again, it's got the same sort of metrics, very high returns on invested capital. All these guys are basically using consolidation, 15 to 20% growth. Asbury, return on invested capital of 20%, again 15 to 20% return growth, and then a PE of 6. That one, again, the same thing is happening there. They're all three of these companies I would consider to be companies that have good, all of them focus on operational improvements, making the business better, in addition to having excellent capital allocation in terms of what to really do with the excess capital that each of them generate. They're in the stage of where each of them are generating excess capital, and the real question is, okay, what do they do with that capital? And the two main areas that they've focused on over time has been either repurchases or buying new businesses, depending upon the prices of the new businesses. And so that's a strategy that I think really makes sense over time. And this is where these companies have done this in the past. And the real question is, will they continue to do it in the future? I think they will. I think they've got the tools to it, and they've done it in the past. One thing you can look at them, their stock prices have gone up quite a bit, but the way I look at this is just sort of like a longer train, and we're trying to say, okay, which is the train going to continue to move along at the same pace as it has in the past? I think it is, and it will. And the real question is, okay, what kind of a market can they grow into? And all of them have nice sized markets that they can continue to grow into. And so one thing that we're looking for situations where we can get, a target of 20% sort of growth returns with no multiple growth. So in essence, there's three drivers of values of the business, right? There's net income growth, there's multiple growth, and then there's share repurchases, and those are the three sort of drivers of values of firms. And so what we're trying to say is, okay, let's assume there's no multiple growth, because of the three metrics that are there, multiple growth, in my opinion, is the most volatile and probably the most unpredictable, because it's really dependent upon the way the market looks at the company at any given time. So if you can find situations where we can get 20% growth per year by just looking at net income and call it like share repurchase type situations, then I think that's the kind of situation we're looking for. And then if you combine that with a multiple that's low, you're not dependent upon the multiple to get growth. But if your multiple does grow, you'll get higher than what you actually get. And so two examples of those types of situations that I'm finding right now in the market are sort of recurring revenue from dealers. And some characteristics of the markets where we can see this is dealers compete in very large and fragmented markets. Even in your local areas, you probably have like a lot of local dealers. Primarily, the market is propagated with local dealers. There are some national dealers that are rolling up, which is one of the key things that we're focusing on. But in essence, it's a very large fragmented market. Most of the participants are privately held. What that does is that, in essence, keeps the prices more rational in terms of people trying to roll these things up. And then many segments have no PE ownership. The OEMs, in many cases, will not approve selling dealerships to PE, which helps us as minority shareholders, because sometimes I've noticed as a minority shareholder, PE, although it can be good for a short-term pop, to a certain extent, they can become competitors of investors, especially in companies that have really good economics. And what ends up happening is, in some cases, I think they get taken out for prices that are under their value, because the PE folks can know how to work the system. A lot of these companies in the end are owned by index funds and other participants that are not fundamental value investors. And if that's the case, their reason for holding the stock is not congruent with long-term value creation, and therefore they're willing to sell it at a price lower than what other investors may think. We have a certain specific situation in Consolidated Communications where that's happened right now. A company we held that we think is probably worth, 15 to $20 a share, but it got a bid price of only 4.7 that the board accepted, primarily because, in my opinion, they think they can get enough shareholders who are basically people whose objective of holding the stock is for a shorter term gain rather than for the long term value creation. I think we see that in a lot of situations where PE is involved in industries, in a number of different industries. We had a previous situation in a company called At Home where that same thing sort of happened. But the nice thing about dealers is it's something that's not there. So it keeps the multiples of the prices being bought at reasonable amounts, and doesn't, it basically eliminates that area of competition in terms of buying and selling businesses. Another area where there's some interesting stuff recently, I mean, you've probably all heard about the different stuff that's going on with banks. Some niche banking services. So some of these companies, a lot of banks are having problems in terms of overall what's going on now, but there's some niches where there's some really interesting situations where you can get like 20% returns on equity in what I would consider to be a very consistent basis. These are four areas that I think and we're looking at these, and this is an area I think of high interest for us to reinvest some of our money from some of our special situations that are playing out. There's specifically efficient spread lenders, which are guys that really can have a good amount of interest rate spread, probably a supportable 3 to 4% interest rate spread, but basically operate in a really efficient manner so they have low costs, and that can very readily turn into a 20% return on equity. So a second group of them are a series of sort of banks where banking is more of an on-ramp for other services like processing or trust services. Again, banking is used as part of it, but the real core of the business are different businesses outside of banking. The third ones are low cost deposit niches. These are companies like like where basically they've got some kind of some niche. Either a lot of it can have to do with ethnic banking or low income incentive type banking, where the cost of funds can be really low, in some cases close to zero. And what's happening in the interest rate environment, as the loan the loans that they have increase in interest rate, going up to 4 to 5%, say, let's say if your cost of funds is zero, the math very easily becomes, you can very easily get 20% returns from that perspective. And the other places are sort of higher yielding loan niches. Those are a little bit more challenging because in a number of cases, those that can usually, if you're getting higher yields on the loans, there, you have to have some kind of underwriting advantage. And typically that ends up with higher, I guess I would say higher risk loans, maybe a higher percentage of criticized loans, those types of things. So that's something that's there, but it's not quite, I think, as prevalent of where you can get a safe 20% than the first three factors that we have on here. So next, we're going to talk specifically about dealers. This is an interesting area. We've invested in two different dealers in the portfolio. We have an auto dealer named Asbury Auto Group, which is an automobile dealer, and we have a Caterpillar equipment dealer called Ferry Corp, which operates in Peru and supports the mining industry in Peru, provides all the Cat equipment. Cat's the #1 market share for mining equipment. And what these guys have done, which is really interesting, is they've built out in Latin America whole sort of maintenance facilities, and the big mining companies outsource maintenance to these guys. So you get a really nice recurring revenue stream. And we'll see in some of the stuff going forward, well, how do we break out sort of the revenue and gross profit of each of these businesses to see how much of their business is recurring versus one time, versus many of the OEMs that primarily just have one-time sales. And so in essence, when you look at dealers, there's really three businesses. There's new and used sales of the equipment, services and parts, and financing, which can provide recurring payments. What we're focusing on and trying to identify is what's the service and parts aspect of the business, because that and the financing, those combined make the recurring pieces of the business, which businesses that have recurring revenues sell for much higher multiples typically than those that have one-time sales revenues. So we say new and used are one-time, service and parts are recurring. What we can see is the amount of recurring revenue will increase if there's a larger installed base. So if you're starting an industry and you just start selling a product, for a while, a lot of it's going to be new product sales. But as the market matures and you get this larger installed base, and you get more recurring revenue from service and other items like that. And again, the revenue can vary by type of dealership, and we'll show that next, and sort of where we've sort of selected to put your money at this point, in terms of the various segments. And we're continuing to look at these because the returns on equity are very high. And again, the multiples are very reasonable from that perspective. So the highest ones actually are construction equipment and trucks, have the highest sort of recurring revenue. The lowest are boats. And so here's sort of an overview of that. And you can see what I've highlighted here in the bold. Those would be considered sort of the recurring revenue pieces. Now, over to the left, this is based on gross profit. Over to the right, the companies don't break out gross profit, but you can make an estimate that the gross profit of service is going to be much higher than new and used sales. So when I look at those numbers, I say those are probably, like, as a percentage, are probably like 80% plus recurring revenue. And that's for Finning and Ferry Corp in terms of the construction equipment. Now, there's in this overall scope of things, there's a very interesting ratio called the absorption ratio. And the absorption ratio measures how much SG&A is absorbed by the recurring revenue. So in other words, if they didn't sell any equipment at all, would they be profitable? Now, if the absorption ratio is above 100, it would say yes, they would be profitable. So they could just basically, not sell any new equipment and then just roll out. That's what it would be. If it's less than 100, then it says it's really dependent upon new sales to really have the thing going. And that's also measured in terms of, from an economic perspective, how economically sensitive companies are going to be to new sales. The ones that have more of an installed base economically are not going to be as sensitive as the ones that do. So for example, let's take a look at the boats, one World Marine. Now that company, it's about 76% of its gross profit is from boats, new and used boats. So that's only 34% is sort of in the recurring bucket. So what's going to happen there is they're going to be heavily dependent on on the new sales to really the the overall profitability of the business. And you can see the absorption ratio sort of shows that. And right, the next 12 months return on equity is relatively low. So when the cycle goes down, you'll see the profitability go down, but when it goes up, it has nice operational leverage going back up. At this point, we're sort of probably going into a down cycle. So I think the steadiness of the revenue is an important differentiator. And so if you take a look at these, you'll see the returns on equity are very good for a number of these types of businesses. And then as the install base gets bigger, again, it becomes more of a durable type of a number in terms of you can count on it in most times. And so where we've invested at this point has been in Asbury, which has, combination of these really good sort of durability metrics, return on equity metrics, and then has a very modest valuation, 6 times EV to EBITDA. I mean, I think the multiples at this point are probably like, 6 to 8 times earnings for Asbury, which again will get us to our 20% sort of return on equity type of. They retain pretty much all of their earnings. They don't pay dividends, so that gets us clearly goes over the 20% hurdle. The other company that we own is Ferry Corp. Ferry Corp is again the cat dealer in Peru, has a lot of contracts with the major mining companies in Peru, and some other dealership stuff it's primarily in Latin America, but the big one is Peru. And again, sort of their return on equity is 20%. Their EV to the next 12 months EBITDA is 3.6. Their multiple is like 4.5. So again, both of these companies have both a durable advantage in terms of the way that their gross profit is structured, decent absorption ratios, high returns on equity, and favorable multiples. And the combination of those three, I think, will lead to very good outcomes overall from a investment perspective. Now we're going to go specifically into Asbury, and Asbury is one of the companies that's in your portfolio. This company basically is the 6th largest automobile dealer in the U.S. Again, the way to think about a lot of these businesses, these dealership businesses, is they're local. They're basically a collection of local markets, and that's where the economies of scale and network effects really take into account. So from a national is really just an aggregation of local. And what these guys are really doing in Asbury is they're developing value-added products and services to increase the stickiness. So they have auto service, financing, and the other thing that's recently happened with a lot of these companies, they've developed sort of an online type of a system that can handle everything. In Asbury's case, it's a product called ClickLane, which can handle buy-sell transactions for new and used cars. You can schedule your auto service. They've got a financing marketplace, and so there's a lot of different pieces that these guys are adding on and actually adding stickiness to the customers. Because I mean, from an automobile dealer's perspective, what you really want to do is the buying and selling of cars is the first step in a process where you want to basically provide an environment for the customer so they feel really good. And Asbury's won a number of awards for not only customer service, but best places to work and stuff like that. So there's other sort of qualitative metrics that Asbury has where you can really see that they're creating this type of environment to enhance the customer experience of buying cars. Because clearly, I think if people get a good customer experience from a dealer, there's no reason why they would go to a Carvana. There's some people that are going to go to Carvana and these other guys that are basically doing the low cost kind of stuff. But in essence, and what Asbury also does is they will deliver cars for free within a certain region, but beyond 40 miles, you have to pay for it because they figure, okay, with it outside of 40 miles, they're probably not going to be a recurring customer and not going to come back to us for service and stuff like that. So they have a very focused approach on trying to provide these services that a lot of these dealers are starting to do right now. So now this overall market is large and slow growing. They've what's happened over time is the return on invested capital, return on incremental invested capital. And what those are is, okay, how much investment you put into the company, what's the return you're getting out? And then the return on incremental invested capital is looking at the change in that metric. And so it's important to really understand both. And this really corresponds to the moat. So one way you can think about, okay, return on invested capital on a snapshot. It's sort of like, oh, here's the moat where it is today. You have a high return on invested capital. You probably have a moat today. Now the question is, okay, where is the moat getting fatter or is it getting more skinny? You can take a look at return on incremental invested capital to sort of see how that's really happening. Because it can happen in a number of ways. Either the business can be declining, which you don't want to see, or the other way it can happen is if you overpay for acquisitions and your return on incremental invested capital is going to go down. And that's sort of another way that it can really impinge invested capital. And so those are the kind of things we look for. Right now, the 5-year return on incremental invested capital for Asbury is 25. And again, these are driven by what we want to see, which is sort of operational improvements, higher inventory turns, local customer scale, mergers, synergies, those types of things. And in essence, in the last quarter's update, we did a profile of Henry Singleton, and he's probably, I would say, the prototype or the example, the example of a individual that exemplified this. And probably there's actually a good book called Distant Force if you're interested in studying one of these guys. He's probably one of the best ones. And I think Warren Buffett has said he's probably the best capital allocator he's ever seen. And so if Warren Buffett says he's a good capital allocator, Warren Buffett being a great capital allocator himself, he's somebody to pay attention to. So again, this is just more stuff, more aspects about Asbury. The interesting thing about these businesses is basically they generate a lot of cash flow and they can continue their growth by only having to reinvest 35% of the cash flow that the company generates. So they have 65% to either buy back shares, grow companies. So this company basically becomes internally, the growth is funded by internal cash flows as opposed to being dependent upon the capital markets. And again, here's the tools that this management team's been using. Again, sort of consolidation. They've had 17 since 2014. They've divested dealers. So not only have they bought dealers, they've said, okay, they have this clustering strategy. When you buy a dealership, a lot of times you sort of buy it and you get what you get. Sometimes the dealerships that they buy may not have dealers that are in markets they want to focus on. Therefore, they'll divest them and basically use the funds and then use that either to pay down debt, buy back shares. There's a number of different things. So when you do acquisitions, especially in a business like dealerships, you have to sort of be able to sort of segment out what you want to keep and what stuff do you think makes sense. And it may be worth more to someone else who may have dealerships in a market. Let's say you buy a dealership and they've got a store in one really remote city. It's worth much more to the guys that already have dealerships in that city than to you, from both a local economies of scale perspective, but also from a management perspective in terms of actually running the various dealerships. They've also repurchased shares. So this management team has been very flexible in terms of the way that they've dealt with capital over time and really proven that they're, in my opinion, a very good capital allocator. Right now, there's modest valuation, maybe 6 to 7 times earnings. Again, that depends upon, what a lot of these guys are going through earnings sort of compression at this point. And so the real question is, okay, well, what's a normalized amount? I'm thinking, 6% is probably about 6 times is probably about where it is right now. So, I mean, if you're talking about maybe, 33 to 35 times EPS, but I think what they have is actually a growth plan to get up to $55 per share by 2027. And so, and I think it's a very doable plan. And so if they do meet that amount, then it's considerably less than 6 times. The historical growth is 30%. The expected growth is 15 to 20. So again, you've got really good metrics in this business. They seem to be reinvesting. They've got a good capital allocator. This is the kind of situation that we really like, and it's selling for what I would consider to be a very modest multiple at this point. This is just sort of a chart to sort of show what's happened over time. You can see it's actually gone up over time. And again, I think this particular train has a long way to run because, the top dealers don't have a very large percentage of the market share of these markets. So this thing, it's been going on for 10 years. It probably can go on for another 10 or 20 years and still not run into any issues. So you do have a long runway for these guys to continue to reinvest and do what they've been doing. And so the next thing is sort of our, investing in compound growth. This is, so again, sort of like where have we sort of been focusing our efforts in regards to try and find sort of what I describe as sort of unrecognized growth that may not show up in firm pricing. A lot of times analysts and other people aren't going to project M&As, buybacks, and corporate actions. in their projections. And those are the kind of situations that we like to find where management teams have done those or are doing those in the past, because that's where the opportunity is, because it's not going to be reflected in analyst estimates overall. And it's just sort of a convention that's gone on. We're also looking for firms that are transitioning from, let's say, a lower return on invested capital to a higher return on invested capital. And what that really, in those situations, what you'll see is they have a low return on invested capital, but the return on incremental invested capital is much higher. And that's sort of what leads to that transition. So we look at market factors and strategies to determine if this is persistent or durable. So again, the focus is focusing on sort of durable situations. The situation exists, should it exist, and why shouldn't, or maybe there's some issues of why it would fade going forward. And other specific, and we'll see it in our example of North American construction, of we feel that that's persistent, and there's certain factors in that business, given its location, that would say that the advantage is much more durable than if they're doing the same things in, let's say, in less harsh conditions from that perspective in terms of people and personnel and actual equipment. So examples of companies doing these transitions that you have in your portfolio are Auto Hellas, TerraVest, and Academy Sport. And so again, we're looking for these businesses that are they're just rolling these things out. One of the key things we look for is sort of, if we look at profit value chain of a specific industry, we look at, okay, where's most of the where's a good portion of the profit captured for not that much capital. And that's led us to a lot of distributors, because a lot of distributors are situations where they get a piece of the profit chain, but the amount of capital they have to invest to get that piece of the profit chain isn't that high, and it does have a long runway for growth. And then what we'll talk about also is, why, when bigger is better, why is that the case, and how that really happens, in some examples of accretive consolidation growth. And so the value chain analysis, we've looked at these ones, auto, infrastructure, housing, leisure, any other types of RV Marines. Will take a look at specific value chains, then identify businesses that are in those value chains that seem to have high ROIC. And as mentioned before, some of those happen to be actually distributors. In the case of North American construction, it's somebody who's provided a service and found a more efficient and capital efficient way of providing this service at a price that's very competitive with the competitors in the market. But what they've also been able to do is they've focused on markets that aren't as competitive. And that's an important aspect, and given sort of where they are. And the question is that sustainable? And we'll see, when we talk about it, we'll see the specifics, but I think that's one of the key things you need to take a look at. And so example, we look at for growth drivers for large profit pool, large profit pools, consolidation is important. Organic growth can be important, but you still can get a decent amount of growth outside of organic growth, but you do need to have some kind of organic growth. This is a much harder thing to do in industries that are flat or going down. It can be done, but it's a bigger stretch. Things that are cyclicality, again, looking for businesses that maybe not as cyclical, that are tied to cyclical businesses. And then sort of transitioning businesses that may be transitioning, they've got a certain percentage of revenue in one part of the business, a smaller percentage in another part of the business, but that's becoming larger over time in terms of becoming more of an example. And our portfolio is a company called Thrive. It's a software company. Thrive also is a legacy Yellow Pages business company. And so what they do is they've used the cash flow from the Yellow Pages business to fund the SaaS business supporting the same customer base. And so that's an example of a transitioning business. And we look at those as being very interesting also, because the market, usually if it's a smaller, fast growing business, the market won't sort of capture that in the valuation until it reaches a certain size. And if the growth is happening over time, it will reach that size and will be re-rated as a result. So when is bigger better? This is, again, just sort of a general thing about economies of scale. This is where we can see economies of scale in terms of consolidation, higher margins and turns with larger size. There's local and national economies of scale, where we have a tendency to focus a lot of these on the local economies of scale. Cash flow, again, organic growth, consolidation, and capital allocation are aspects, and we sort of talked about this before, but this is just sort of like some of the things that can enhance. So, and to a certain extent, what we're really looking for is management teams that can take advantage of this and have consolidation as being an additional factor to basically make the snowball get bigger faster over time. And basically, this happens a lot of times in fragmented markets.
Keith,
Yes.
Keith, we had a question come in,
Sure.
if I could interrupt you.
Sure. Yeah. No
Um,
problem.
How do you size individual positions on each theme? You can use auto dealers or construction as an example. Is it upside or downside driven or both?
What I've done, I think, in terms of let's say dealers, each of those I've initially put in at the auto dealers a little higher, and then the construction dealer a little bit lower, but as a certain percentage of the portfolio. So I think the auto dealers we probably started out at like 5 to 6% initial investment. The construction dealer probably about 2 to 3%. And I think from a sizing perspective, I think that's sort of where. So I've got really two buckets. I think ones that are primarily, I would say, 5% would be sort of a big position, 2.5 would be a smaller position. I think, and what I've noticed, and I think the way that we're going to be running the portfolio is, sort of see what happens with these things. I mean, and I'm going to let some of the positions become very large percentages over time if that happens. So, for example, we have a company called Ashteed that basically is a company where over time we visually sized it at like 4 to 5%. It's gone up to 8%. I mean, Asbury's gone up from 5 to 8. I don't have a problem when they get to those type of numbers because in essence, I think what's happening is, the market has recognized it, but I still think it's still a relatively growing type business. I mean, one observation that you can take a look at is probably more Warren Buffett's portfolio, which is interesting because I think what we don't see that's under the hood is a lot of the turnover that he has before the 1 year point when he needs to report his holdings. And so what we see the residual over time is what he's held on to and what he's felt comfortable with and what he's seen businesses like what we've seen, for example, in Asbury as time has gone on, seeing management teams do the right things, have the good capital allocation. It's one thing to sort of say, okay, this is what they've done in the past, but then to get conviction, believe they're going to continue to do that in the future, that's built over time as you hold the company. And so I think that's sort of how we've done it and how we're planning on going forward. What we're actually doing to give you an example of, okay, let's say we've got something that's a situation where a special situation is going to take us out. But for example, in consolidated, we'll sell that, and then we'll buy another position, maybe somewhere between 2 to 5%, and then we'll sort of see what happens, and then over. So it's more of a process of buying new companies and continuing to I guess monitor the businesses and see how they're doing over time. Are what we expected the business to do is actually happening, or is it getting worse? If it's getting worse, then we really need to go back and revisit and say, okay, well, maybe we need to move on. And so what you get, I think, as a result of that over time is you should get the companies that have met your initial expectations and will continue to go forward, and the ones that haven't, they've been culled out over time. And I think that's sort of like the way that if you look at Buffett's portfolio, that's sort of the way it's done. I think it's a very interesting way to sort of do portfolio management is basically just because by nature, if you're right, and in most of the cases, we're looking for significant upside because we're not only going to see growth at 20%, but we'll get multiple expansion. The value will go up, and the businesses that we're buying are ones that we feel we can hold on to forever if we need to. And so that I think is in nature the approach that we're looking at for these new businesses that we're putting into the portfolio. So hopefully that answers sort of the sizing question and how that's evolved over time. I mean, initially we talked about, if it gets above a larger percentage of the portfolio, we would take a look at it, but we haven't run into that situation yet. If something gets to 15 to 20%, then we probably need to take a look at it. But at this point, nothing's really approached that. If it does, then I mean, we'll deal with it at that point. But at this point, the highest percentage in the portfolios are the three highest percentage companies are roughly at 8% each. And the three that we had mentioned there, it's Asbury, Ashteed, and Builders First Source are roughly 8% apiece. And those are the top ones that we have. And if it does become more lopsided at some point, that's something we'll have to take a look at. But we haven't done that. I mean, at that point, we'll take a look at what's going to happen. So, but I am aware that some portfolio managers have run into issues when they have let some positions just grow to be an outsized proportion, 40, 50% of the portfolio or something like that. Then the portfolio basically becomes a bet on one stock. And I think at this point we're not there, and when we are there, then we'll address it then. Okay, so I don't know if there's any other questions. If that was the only one that's there, but okay.
Only one
Um,
so far. Thanks, Keith.
okay, great. Um, so in terms of capital allocation champions, these are basically people that are running businesses that basically are really doing great capital allocation to magnify. So businesses going along, capital allocation decisions really are, when you take a look at it over time, are huge portions of what the returns on these companies can be. So the investment cash flows. So basically, what is the investment of the firm cash flows? And there's different options they can have to do on this in terms of what they can do with reinvestment. This becomes a very important piece. The real question is, what do management do benchmarking? Do they examine all the alternatives? What's the return on invested capital deployed? How many shares can be repurchased at a discount to the current stuff? So ways to sort of look to measure how good management teams have done is, do they examine all the alternatives in the cases? Yes. What's the return on incremental capital, which is that's the thing that we measure every year of all these businesses, and we use that as an initial filter to buy the businesses, and those will continue to increase. And another interesting question in terms of repurchase: how many shares are being repurchased at a discount to the current share price? If it's been a very large amount, then it's been a good investment. If it hasn't been, then you really need to say, okay, maybe they need to go back and take a look at that, and how honest has management been about that, right? Because I mean, a lot of times if you buy back shares at really high prices, you don't see management teams saying, "Oh, we made a mistake here." But in terms of being able to to improve over time, I think you need to acknowledge that that's the case. And so, if you take a look at, for example, at Asbury, I think their average purchase price is somewhere in the 80s, and it's selling for 160 right now. So, or one, excuse me, one in the 190s right now. So, in essence, it's a significant increase. It's been I would say a very, very accretive or very positive share buyback program there. Um, and then the key thing is growth, good capital allocation with a low valuation. And again, the best capital allocations depend upon the stage of development. Most of the firms we're looking at, I say, would think are either in the growth or more likely in the mature stage of development. And so the companies do have ample cash flows to basically use to be invested in these options. And the real question is, how much of that future growth is priced in today? You just take a look at the multiples. I mean, if we're talking about multiples of 6 to, let's say, 15, at 15, you're talking maybe 3 or 4% growth is sort of what the implied is on that 6. It's probably implying negative growth. And if that's sort of the PEs we're buying in, and our growth that say is 15 to 20, eventually the multiple will re-rate, but we don't want to necessarily be dependent upon that. That's almost can be almost looked upon as a bonus. But if we can find companies that are growing and the multiples going up, that's where you get the Lollapalooza effect of these multi-bagger type companies. And again, Henry Singleton's a great example of this. He's got a book, Distant Force. If you're interested, let me know. I mean, it's a really a great thing. If you go back to our last quarter's update, you'll see sort of some summaries of some stuff that he's done. I've done some additional work on him. So if you're interested, just let me know. We can talk and discuss that. But I think he's a great example of a manager that a lot of folks should emulate, at least provide some kind of a benchmark to compare other managers out there too. So why don't we dive into like one of our recent purchases, North American Construction. What I like to describe, sometimes you like to describe these businesses as simple as we can. What these guys are basically is they're dirt movers and contract mine operators. But how do they differentiate that? There's a lot of dirt movers and contract mine operators. By dirt movers, I mean these guys have all these big dump trucks and move dirt from one place to another. And they get paid by the load of dirt that they move. And it's primarily supporting oil sands operations. Oil sands is primarily a mining operation where you scrape up dirt with oil sands in it, you dump truck load it to a facility that processes it and separates the oil from the sand, and then you take another set of trucks and you dump the dirt back. So in essence, it's very similar to mining. Mining has a lot of the same characteristics in terms of moving dirt and stuff around. And so that's primarily, and the key aspect to this is harsh climate. Now, one of the differentiation is that in harsh climates, the competition is as much. And the other aspect of it is the equipment is put under much more strain. And therefore, you need to maintain the equipment better So the harsh climates that they basically have operations in is in the oil sands, which is in northern Alberta, which gets pretty cold in the wintertime and it gets warm in the summer. It really gets cold in the wintertime. They also have operations in diamond mines and other sort of mines with on sort of what they call ice roads in Nunavut and other parts of northern Canada. They have operations in coal mines in the US, and they just bought a company in Australia that has operations in remote locations in Australia. The other part of their business that's more dirt moving is they also have a, uh, a construction contractor to basically um, move dirt around for a water control project. And they work with a particular contract there, and they're hoping with their Australian subsidiary, now they've got capabilities in Australia to use to leverage the relationship they've got with the very successful operation they've done in North America to get some more of those types of longer term concession mine operations. They basically move dirt and operate mines in northern Canada, remote locations in the US and Australia. They've got the largest heavy construction and mining fleet in North America. They focus on utilization, which again, going back to the whole idea of, okay, do these guys have operational metrics and are they focusing on them? So they do focus on that. That in conjunction with having their own maintenance people to basically extend the life of this equipment to the longest it possibly can be. They have long-term contracts. Right now, their current backlog is about by the end of the year. Now they're expecting it to be between 2 to 2.5 years, which is great. I mean, that means they have recurring revenue for the next 2.5 years. A lot of the other people in this space, they'll have recurring revenue for maybe a year at most. I haven't seen anything much more than a year. So these guys have some really long-term sort of situations. We partnered with indigenous groups in relevant jurisdictions. So in Canada and in Australia, they basically partner with indigenous peoples, which basically a lot of the governments in those two jurisdictions have given favor to, hiring and being part of indigenous partnerships. And so North American Construction has done that in Canada, and that's worked out. It's worked out well for them. One thing which is interesting, though, a little bit different, I think, than a lot of other constructions is they're focusing on reducing the capital cost of this particular equipment. So again, they're thinking ROIC on these construction projects, and they've got some longer term contracts. They got ROIC, and then that goes into their pricing. And then if they're doing it in harsh climates, it leads to basically limited competition. So those combination of factors have led to some really good economics of the business, where initially it may not have been good, but over time it's increased. And then they also figured out where some value added service to increase customer stickiness. So like mine end of life operations and servicing other firms' equipment. So basically this, they have this group of people that are good at servicing their equipment. They also outsource it to other operators, let's say in that region. There's a large and growing TAM. What's this really being driven by? It's driven by infrastructure projects, which are becoming more and more in North America and in Australia. Also oil sands, coal, and metal mining demand, which is being driven by a lot of this green transition in terms of additional mines. Oil sands, just in terms of oil prices, they're actually, they're just about finished with the oil pipeline in Western Canada, which will basically increase the capacity that they can send oil out and for export out through British Columbia, and that should be a big boon for the oil sands in terms of increasing the demand. Because part of the issue with a lot of the resources in Canada is just the infrastructure to get the oil out, and that's being increased, and that should be very favorable for a company like North American Construction, where if they can, basically they've got a certain amount of fleet. If all they're really doing is just increasing the number of loads that they can do, then that's really good for them, because on an incremental basis, the returns are just really high. And then again, so a high and growing return on invested capital and incremental invested capital. Those are the numbers there. And again, they have these operational improvements, high utilization of maintenance services. What they're focusing on, they diversify the contract base. They've gone from, like, previously they were just an oil sands person, so they had like maybe 5 guys, and now they're up to like 23. And so, excuse me, 35 after the Australian. So basically it's getting better. It's getting bigger. It's getting better because it's more diversified. Indigenous partnerships in real estate. What I thought this sort of gives you an idea of a pictorial over time of what's really happened with the business. So if we look at this as a story, okay, a new CEO comes in 2012. The new CEO says, okay, we know this business is very cyclical, and what can we do to make it less cyclical. And his focus has been, okay, what we're going to do is we're going to do some operational improvements. We're going to focus on, okay, let's take where our capital is being invested. Can we make that more efficient? So that's like the example of the, focus on utilization, try to do better buys with the OEMs, try to basically make that efficient to become the biggest owner of this type of equipment in North America from a scale perspective. And so that's what they've done. Diversification. So basically, they're not dependent upon oil sands. So they're first moving into diversification with the acquisitions they made in 2018, which were primarily acquisitions of companies that mined other minerals in Canada, diamonds and other stuff in other parts, and developing the indigenous partnerships from that perspective. And then the mergers that they had. So as you can see by the chart here, you look at the we have return on equity on the bottom. It sort of seems to be pretty scanty before 2018. So that was sort of the original business they had. They bought two businesses in 2018. And you can see from that point on, the return on capital is just increasing. Return on invested capital has been very positive. And despite, going through COVID, I mean, COVID was right in the middle of this thing. So, right. So COVID hit a lot of companies, but in this particular instance, their cash flow from operations exclusive of working capital kept on going up. I mean, part of the reason could have been, I mean, I've talked with some people that are involved in these type of operations, and they've stated that what happened during COVID was that they were able in these contracts, when you send this equipment up to do some of this work, it's in these really remote areas. So in the summertime, when the permafrost melts, you can't take the equipment out. In COVID, when everything shut down due to the limited competition of what was here, they were actually able to write into the contract, if we don't use the equipment, you still pay us. So they got paid for equipment that wasn't even used in these northern parts of Canada. And that's, I think, what kept up sort of the cash flow in this business. So I think they've got a number of different advantages. A lot of them stem from just the lack of competition. These are really remote areas, and you not only have a manpower shortage, but you also have an equipment shortage. And so those combined with the indigenous partnerships create, I think, a very sustainable and durable moat for this business, which will continue to grow into the future. And then when we look at this and we step back and we say, okay, the acquisitions, like we said, has led to less cyclical and higher ROEs overall. We step back and take a look at this. This business is a little bit more capital intensive than, let's say, the dealerships. They probably require 55% of operational cash flow to basically maintain and grow the business. But again, they've used the same tools that we've talked about before that Asbury's used. So you've got consolidation. These acquisitions have basically made the business very, very, very added a lot to ROIC and ROIC. They made a recent acquisition, which is going to expand the geographic scope and expand the customer base to 35 from 18. And then it's going to increase the free cash flow conversion. So in essence, what these acquisitions are doing is they're getting bigger and better over time. And so the bottom line on all this is they put together what they think is going to be the projected cash flow after all the acquisitions, after all the acquisition is integrated in 2024. Right now, they think the free cash flow they'll be able to generate is $175 million. The company's selling for like somewhere in the 500s millions of dollars in terms of market cap. So that's 3.5 times free cash flow, which basically is saying that you buy a company for 3.5 times free cash flow that's had 33% historical growth and 25% expected growth going forward. So this business is a real, I think, a real special one. I think that again, this goes back to, I think, again, sort of our mischaracterized companies theme, a business that's doing something a little bit different, focusing in areas that have high returns on invested capital. And it's really created a result that isn't expected in these types of businesses. And these are the types of things we like to find because, on the surface, people would say, oh, I don't even want to look at this business because the returns on invested capital aren't good. When you find something like this, you just say, wow, okay, well, this is the exception that really can create some interesting aspects or synergies here. And so this is sort of like, we had this in the last time, what we were looking at in terms of trying to as the portfolio is transitioning to more of these these better businesses, it's still at reasonable prices. As we noticed up front, the weighted average PE of the portfolio has not changed that much. It's still a value portfolio, yet we're able to buy these incredible businesses with really good returns on capital, really good historical growth, and really what we think is really going to be good growth going forward, from that perspective. And that's sort of, in a nutshell, sort of what we're doing. We want to ensure that there's a good amount upside, and we'll use that 15 to 20% sort of expected return, probably upper teens to 20% expected return is a basically a threshold before we'll put anything in the portfolio. And that those are the situations that we're looking at now. And so we've done that with a number of holdings, and we'll continue to do that as time moves forward in terms of where we think the market is today. So if anybody, that's the entirety of the presentation. If anyone has any questions, feel free to
Yeah, a lot of
listen.
information to pack into an hour, and really appreciate everybody joining us. Looks like, wait, we've got one question. You've talked a bit about BDCs and
Mhm.
other dividend generating holdings. Have you bought any? And if so, what percent of the portfolio are they? Thanks for the question, Reno.
That's a very good question. At this point, I think we are going to start to buy some of those types of businesses if we're having a hard time trying to find companies that meet the upper teens 20% ratio. I think that's a very good place to put excess cash that we have in the portfolio. We'll see what the situation is like, when the when some of these special situations play out. And if it's the case that we can't find anything that meets our quality, durability, growth, and valuation criteria, then we will definitely put some money into that, because that's clearly a better alternative than holding cash at this point, even though cash is a great alternative today. You get
Mhm. What
5%.
percent, just to follow up, Keith, to that, what percent of the portfolio is currently in cash, roughly?
We've got about, at this point, $500,000 in cash. So that's, I don't know what percentage of that would be. So our total portfolio is what, about 14 million or something like
About
that. So
14 million.
14 million. Yeah. So that's, I don't know, that would be 0.5 divided by 14. Wait a second here. Can't do that in my head, unfortunately, but, you've got about 4%. 4%. And then if you count sort of some other positions, we have a little bit more, like the consolidated, which in essence in my mind is cash like, because it's a fixed purchase price. But in terms of pure cash, it's roughly around 4%. I mean, the nice thing about consolidated at this point, there is a good amount of, I guess what I'd say, expected return in the control premium, in the price. So if the price of 470 gets paid in the first quarter of 2025, which is sort of what they're expected, there's an implied, about 10% return in that by just holding that. So that can be another one, but I would feel more comfortable with probably at some point. We've got some of these holdings that we're looking at, and again, I think at some point we will. I wouldn't be surprised for a company like Sixth Street to show up in the portfolio as sort of an excess cash place to put excess cash.
Keith, we have one last question. We are over the hour mark, but if you can just speak a moment on, we're seeing ABG and LAD this morning are missing earnings and are having their operating margins compress more than expected versus COVID highs. Have you adjusted what their run rate for earnings should be? How do you think your view differs from that of the market?
Um, you know, I, I have made adjustments. I mean, I think right now, um, like for example, Asbury probably can generate at this point, I think going forward, probably 35 dollars per share of earnings. It's selling, I think yesterday it was what, 195. So I mean, so again, you're talking, relatively low multiples of earnings, even with that. So I mean, let's say let's say we go 35 divided by, let's say 190, that's a that's about a five times earnings multiple. Five times earnings multiple implies declines. So I think based on today's earnings, I think it's cheap. But then I think the real thing that I've been focusing on is, what do they think the longer term earnings are? So I think they were saying in 2025 they're going to get up to, I think it's 24, 2025, 26, they're going to get up to $55 per earnings per share. As far as I know, that they still are planning on hitting that target, and if they do, then today's prices become even better. I think there is an issue, and you can see it in the. If we go back to, I'll show. Let me just go back to this thing here real quick. Second here. Go back to the dealership thing, and we can take a look at what oops. Yeah. Well, let's go back to this dealership sort of percentage here. And what we're seeing, like you're saying, is there is compression, but I think what's happening going forward, even if you use the lower rates, I mean, even if we use like $35 per share, 33 to $35 per share, you're still in the low fives on a PE basis for Asbury. So I think even though you know, there is going to be some compression here. I think the other aspect of it that's not really sort of calculated into people's calculations is actually the sort of the effect of the internet and the efficiencies that are provided there. I mean, what is interesting is that if you do take a look at the earnings forecast of the businesses, like for example, Asbury, it's still going to be in the 30s, but selling at five times earnings and 30s is coming down from where it was before. So you're five times non non or non-peak earnings is a very reasonable amount. And I think I think you're really going to see a differentiation in these dealers in regards to the ones that do better versus not. And you're going to see just sort of what's happening there from that perspective. So I really feel that in our long-term forecast, we've taken that into account in terms of compression, because the compression sort of assumes over time, that they're going to buy, like they're in the process of buying Kuhn's dealership, and so that's going to increase the amount that's there. And I think over time, just these trends you've seen in the past are going to continue. COVID basically created a little bit of a bump, but I just sort of see it as continuing to go forward. So I like saying, I mean, I think the new run rate at the current amount that they're at is probably 30 to 35. I think with where they expect to be, it's going to be 55, and the stock selling in the 190s. I think that gives you more than enough. It's a really inexpensive stock that has a really attractive growth profile, and I think a really durable competitive advantage in some aspects of the business that are unique to the business, and the fact that PE isn't involved driving up prices, that will continue to allow for a long runway for these guys to continue to buy. Because part of what makes these acquisitions accretive is buying them at reasonable prices. And I think the lack of PE being in the market is going to help the consolidators to continue to do that. I really, in terms of them comparing them to like Lithia, I think Lithia has more aggressive growth projections, and you can sort of see that in what they're doing in the UK now. They're buying UK dealerships, which in my mind is a much less quality type of a situation than we have in the US. You can just take a look at the economics of the businesses in the UK. They've really been, but Asbury is just focused on the US, and so that's and again, the dealership their business they're buying is in Maryland, Delaware, and DC, Virginia, and it's close to some of their other stuff they've got in the Carolinas. So again, it's sort of a cluster approach that they've sort of have focused on. It's a good. The brands they bought have been like Toyota, and Toyota I think going to be an evergreen brand. So there's a lot of things I think to like. I think the model is a great model. My only concern about Lithia is the aggressiveness with which they've done, and maybe buying businesses that aren't quite of the same quality that Asbury would buy. But that's just my opinion from that perspective. I really think that the market is, again, I think what's happening here is the market is valuing these businesses as the way they were maybe 10, 15 years ago, when the much less scaled companies, the margins were much lower and the returns on invested capital, and you didn't have the internet, which really, in my mind, has really accelerated the operational efficiencies that these businesses have. You can look at a company like Asbury over time, the revenue per employee has gone up over time. They've got metrics to track and continue to improve revenue per employee over time. And those kinds of things, I think, you know, they'll continue to do well, because I just think that's just that I think is the difference. And that's where I think the what you can take advantage of today is the market values businesses the way they were, not the way they are and the way they're going to be. And so I think that's I guess a long-winded explanation for what for thoughts on auto dealers. But what the thing about the dealerships too is that I think it's bigger than auto dealers. You can take a look at interesting. I think the construction equipment dealers are also another interesting way. And the nice thing about the construction equipment dealers, it's a way to play sort of the miners with a lot of recurring revenue, and not basically. In North American construction is the same way. Okay, you've got this good trend of mining companies wanting to mine, but in my opinion, one of the issues with a lot of the mining companies is just you've got the operational risk of that, and in essence, you're selling them picks and shovels, and that type of stuff is what we're really doing when we're buying these businesses. And so it becomes much more of a way to play the businesses with recurring revenue, as opposed to one-time revenue and all the risks and rewards that are associated with that. So
Great. Well, Keith, thanks so much for your time, and everybody, thanks for joining us. Just want to highlight that Keith will be participating in a Twitter X event, Woodstock of Micro and Small Cap Investing. That'll be November 6th at 1:15 p.m. That's a live event, Keith, if I'm not not mistaken.
yeah,
And
yes,
yeah, please go ahead and join us for that. And as always, if you had any questions that came up during the session and weren't addressed, or you'd like to connect, please reach out and we'll set up a time to connect directly. Look forward to staying in touch, and thanks again for joining us today. Have a great one.
and thanks everybody.